Hey everybody, should be live on YouTube. I forgot I needed to fix a couple things with the settings on this other new computer that I'm on for the YouTube. So hopefully it's running right. Hopefully it's running right. I do go through more technology than anybody. It's kind of crazy. Thanks, Bill. Appreciate it. What's up, men? Hello, Elliot. What's up, Bill? Eddie in the house. What's up, Varun? What's up, Tate? Good to see you, Jong, Dave. Dave, I didn't fully finish reading what you sent me, but I got through, I think, most of it. I think I got the general gist, and I'm happy to give an overview of that in the meeting today. Thanks, Varun. What's up, Dalakir, Lath? It's great to see everybody on this pretty bullish day. All right, so let's get started. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. I got out of Apple, Amazon, and Microsoft, but I got into Google. How exciting is that? That's it. Let's go over to charts. Thanks, Rich. Appreciate it. Just give me 1 second here. Okay, cool. So yeah, I mean, look, I wasn't expecting today. I was not expecting this today. S&P closed up 1.5%. Q's closed up 2.25%. Oh boy. And the IWM closed up 1.35%. I mean, today was just massively strong. I wasn't necessarily expecting it. I'm not overly surprised to see it. We know that we are in a negative gamma environment. So when the market moves up, it creates more buying. When the market moves down, it creates more selling. Your range of outcomes really increases. I have been looking for this market to recover a little bit further. I've been saying that my bigger picture thought process is actually that we move a bit higher and then work our way sideways. So we'll see if that plays out or not. Today is definitely a day to take notice of. Bulls really took back some major control today. You can see the 5-minute chart here. Beginning of the day is pretty strong. You know, we're already beginning that uptrend, and then things really accelerated at 10 a.m. when the number hit. The JOLTS job opening number came in less than expectations. So on the surface of things, you'd think that could be bad, but if you understand the Fed, pretty much the number one, like, it seems almost like the number one thing that the Fed has really been looking at outside of the obvious, which is just the overall inflation number to go down, is the labor market. And one thing that they have consistently commented on is the dynamics between job supply and job demand right now. That there has been too much supply for the amount of demand for new jobs. So seeing that there are less job openings out there that came in under expectations, that really helped to accelerate the market higher today. You couple that with, again, the negative gamma environment. You couple that with it being the end of August, meaning that there is less liquidity out there generally. You know, we had discussed, you know, end of last week and beginning of this week, excuse me, that while the most likely situation on these types of trading days is to see the price action like what we saw yesterday. Yesterday was just an awfully boring day, nothing going on, market moving sideways, being really choppy. If there is a catalyst that wakes the market up, you can actually get really big moves also. And we've even seen that, not this past November, the November before that, the day after Thanksgiving, which is also usually an extremely slow day, except for every once in a while when it's not, because there's some sort of news event. I remember that Thanksgiving year before last, that Friday was just completely insane. And we got a really big up move. We had been discussing, I think in a couple afternoon meetings recently, that little bullish bearish neutral game that I love to play, where we just kind of analyze the technical trend on multiple time frames to help us assess our probability. And what I had been saying is that we are in a short-term downtrend, intermediate term, looking back a few months here, neutral environment, trend-less environment, and big picture as represented by the rising 200-day, that we are in an uptrend. So we had competing pieces of information: short-term downtrend, intermediate-term neutral, big picture bull trend. What is going to win? Well, what tends to win is the big picture. More times than not, if you've got competing trends, whatever the larger time frame is, that'll be the one that eventually changes, because you can't have a short-term downtrend and a long-term uptrend at the same time last forever. Eventually that short-term downtrend just keeps going and it will roll over the big picture trend, or what's more likely is that short-term downtrend just represents a bit of a bigger technical pullback within the confines of a larger picture uptrend, and then that pullback finds a bottom and reverses higher. And to give some extra credit, really, to myself and to the team, back at the end of July, we called for a 5% pullback, and a 5% pullback would have brought the SPYs to 435. And we went pretty much right to that. We had the gap down on this key day here, that August 18th day, which is such an important trading session for us, where that low is 433. We closed above 435. We basically got our, normal, healthy, happens every handful of months or so, 5% technical pullback on the market. And now we're potentially set up for continuation. We obviously haven't had new highs yet, but I think that today's close, the strength of today's trading session, the fact that we were able to get above, hold above, close above the August 24th negative Maribozu high, which is the day after the NVIDIA report, brings the short-term trend also back to neutral. So we just went from bearish, neutral, bullish to neutral, neutral, bullish. So it's not an outright bull market like what we had in June, where you could just look at every time frame and say bullish, bullish, bullish. Would you rather be long or short? You'd rather be long, provided we're not violating our extension rules. We're not in an overwhelmingly bullish market, but I mean, today is a significant trading session. It's a huge win for the bulls, and it really pulls our time frames back to where you want them to be if you're looking for the market to continue. And I think it's worked out really well. Again, I thought the highest probability situation for today was August 28th, Tuesday, not really much going on. We had a flattish open. I thought the highest probability situation today was going to be similar price action to yesterday. I was obviously wrong on that, but I think that we were able to do a pretty good adjustment to make up for that and be on the right side of the trade. And honestly, even if not, you can still have longs on from the August 18th low. I mean, I just talk about this a lot. And in some ways, it's one of the hard things about trading. There are certain key trading sessions that come along once a month, once every couple of months, and if you can really execute those days properly, and you get a good close, and you're not afraid to swing when you're in a win-win situation, you are still getting paid today for the work that you did on August 18th. And look, I know a couple people in here, Pat unfortunately has spoken about it, and this just happens. It's just part of trading. Pat was on the right side of the market on that day, and it's just the name selection with Tesla just not being able to give any follow-through on that day was very relatively weak, which was just probably super frustrating. I think a couple other people were involved in that as well. It happened to be options expiration that day as well, which I think made for some wacky price action in certain names. But and if that was any of you, you didn't do the wrong thing. You just, for lack of a better term, got a little bit unlucky. And I don't like to really ever attribute anything in luck or anything in markets to luck, because it's just a bad thought process to get ourselves into. But sometimes you just happen to have the unfortunate name selection. But outside of that, there's no reason why you still can't have longs on from that day. I think Brant thought I was joking when I was asking him to close if anybody's still long ARC from the 39.50 call out. 18 cents risk. And I wasn't joking. I was dead 100% serious, because these are the setups that we look for. These are the setups that actually can continue to pay us a week later for doing a really good job on that day, as the stock is at $43.50. This was the conviction buy setup I called out off the open. I had a ton of size personally in ARC that day, where it opened up, called out the long via the buy stop at 39.50 versus lows, literally 18 cents risk. And if you do the right things and you keep it overnight, and then you're willing to trail on a daily chart, you're willing to give open reward back to see what it can do when you're in that win-win, you can easily still have stock in ARC at 43.50 for an 18 cents risk purchase down at 39.50. So $4 worth of reward for 18 cents worth of risk, and potentially the trade's not even done yet. So I personally don't have any. That had more to do with just kind of overall portfolio management. I just had, and this is a good thing, and it's still continuing to pay me now, so I can't complain about it. But at the end of the day, on the 18th, I just had way too much. I had an unreasonable amount of long exposure still on at the end of the day at the 18th, and it was just prudent and responsible for me to take some off. And the way that I decided to take some off was by fully liquidating that ARC position. So unfortunately, I don't have any of that one, but obviously, the reason why I had to do it was because I had so much long exposure and everything else, and that is continuing to pay me as the market works its way up. And I don't have to be, a genius or do anything new or do anything right just to continue to get paid. And if you can combine that maybe with some of the cash flow trading that we've talked about, well, then what you could be doing, just using ARC as an example, if you had really good stock from there, you could be, selling into this up move, rebuying into the pullback, reselling into the up move, and then kind of working these $2 ranges in here, all from the position of a win-win, so that by the time the stock got back to the high of the 24th, of like 42.30 or so, you're actually up even significantly more money than you were when it got to 42.30 the first time. And that's just by, again, position management, being willing to sell some on the way up, rebuying it on the way down, and just kind of working your position to be able to put extra cash flow in your pocket, which is one of the things that I've been spending more time talking about recently, as it's been working pretty well for me. So yeah, just incredible follow through from today. We recaptured some key levels. You easily could still have stock from those lows. The market has now just gotten much more bullish again from a technical perspective. I'm all for it. I spent the day pretty much piecing out of some longs. I liquidated my Apple position entirely, my Amazon entirely, my Microsoft entirely. I'm out of Pinterest as well. But I'm actually still fairly heavy to the long side at this point, though significantly less heavy than I was at the lows of the month thus far, and that's perfect, and it's exactly what my game plan called for, so I'm continuing to follow it. So that's kind of the market big picture. Not really too much to talk about there. A couple individual trades worth going over. One is Google. We identified the relative strength in Google early on. We talked about the key 132 level. It ticked above 132 pre-market, kind of, I think, as I was doing the meeting, and I think as I was ending the meeting, I bought some Google pre-market. I think my price was like, I don't know, 132 quarter or so. I was giving it down to 131.50, which I think my price might have been a little bit better than that. I was giving it down to 131.50. Basically just this consolidation low from the pre-market. You can see even the candle here, which is the candle that I bought on, that low was 131.50. So I had like 60 cents risk, I think, maybe slightly more in Google, and this thing just gave a great opening move on that relative strength. Technical pullback that was a little bit deeper than I wanted, but the ADMA caught up inside 5 and up to break out of that consolidation and then give fantastic continuation along with the market. So that was a good new trade that I entered today, coupled with a lot of bullish option flow we've seen come in on this thing over the course of the last few days. And then, the only other trade really I think worth mentioning, which was not related to the market at all, was, we've spoken about this a bunch of times, is just the step in shorties in the Neo trade. This is really becoming like the one tape reading trade that I think is still like great, and it's a pure tape reading trade, and you still want to combine it with some other things. The thing that I really liked about that Neo short seller break there when they were kind of pegging the offers down as the stock was circuit broken is that I was able to combine it with a really large degree of extension on the 5-minute chart. It just kind of gave me a lot of breathing room for reward on the upside if the short sellers break and you get the bounce. And it was the same thing. Pat put it on my radar. So Pat, I appreciate you for the money today. I owe you lunch or something. But I think, Pat, when you called it out, and I typed it up, there were short sellers there stacked on the offer because, again, we talked about this the other day, so I won't go into too much detail, but when stock is circuit broken, short sellers can't hit the bid. So when stock is circuit broken, you can reasonably tell the difference between long sellers and short sellers. In a normal stock, you can't do that. You know that every red print that you see that goes off in your tape is someone that was long and is selling the stock. Whereas the short sellers can't do that. So the short sellers will be inside offer, and they will peg that offer all the way down. So Pat, communicated it. I knew $10 was an important level. I typed the stock up. I see inside offer is something like $9.77 or something like that. And you can just see on that inside offer all those short sellers just built up there because the liquidity is just very significantly larger on that inside offer than it is at any other normal penny, and that's because the short sellers want to get short really bad. They can't hit the bid. They might even be trying to do like a market order that is just going to peg to the inside offer. So that inside offer was 77 cents. I see all the short sellers there. I just put a buy stop at 78 cents, and then the whole stock decremented a penny, meaning long sellers broke the 76 bid. So now it's 75 by 77, but 75 by 77 extremely quickly becomes 75 by 76 because those, like, faster than you can blink, because the short sellers immediately peg the offer down to 76. So now it's 75 by 76. Long sellers break the bids at 75, so the bid drops to 74, and the short sellers drop to 75. And that just keeps happening. And every time that happens, I use that page up, page down key to then decrement my buy stop to stay a penny above that. So now it's 74 bid, 75 offer, full of short sellers. My buy stop is at 76. And then it drops again. So it's 73 bid, 74 short sellers. I drop my buy stop to 75. It drops again. 72 bid, 73 short sellers. I drop my buy stop to 74. I did that 1 penny at a time all the way down to the low. And at the low, it was 96 bid, 97 all the short sellers. My buy stop is at 98, and then they broke it. Somehow I actually got slightly price improved on it, which is great. Usually actually get slippage in that situation by a few pennies, but I just immediately got filled. I had 2 cents worth of risk on the trade. 2 cents worth of risk on the trade means that every 1,000 shares I take is 20 cents worth of risk before any commission costs or anything like that. And it's just and on top of that, that all these short sellers that just sold at 47 cents are instantly out of the money. They're instantly out of the money, and I'm helping to squeeze them because I'm taking offers and I'm pushing the stock higher with my buy stop. So you get that really fast pop. So I almost instantly sold half my position for 10 cents of the money. And then I just created a game plan for myself to piece out all the way out to the ADMA. And Aaron, you could have that skill. All you got to do is listen in the radio and look at the stock when I am actually talking about it, because when that trade happens, I talk about it in real time. I'm like, there's the short sellers. Oh, wow, there they are. Oh, wow, they're driving this thing all the way down. Oh, wow, I just got a buy stop that's right above them. Literally just communicating what I'm seeing and what I'm doing in real time. And it sounds like a couple of you guys actually got in this one a little bit to learn also. And it's just cool because I think that tape reading, for the most part, which is a skill that I used to be, it's a skill that I have. I'm really good at reading tape. I'll just go ahead and say it. It's a skill that's just completely irrelevant in the modern market for the most part. There's so much noise. There's so much garbage, so much fake liquidity in the level 2, in the tape, the easy money that used to be there 10, 15, 20 years ago just really doesn't exist in the market anymore. But this is the one circumstance where, and it doesn't happen very often, but I think it was just like a few weeks ago that I went over this exact same trade in a different stock. It doesn't happen very often, but once in a while you'll have a name that really kind of fits the bill, and the short sellers are just driving it down, and it's just so obvious that if you can break them, that you might, or that if they break, you might get that that pop from the short squeeze. So yeah, it was great. Do you happen to have the tape in level 2 recorded? No, I've never recorded tape. I kind of just have to see it in real time. And again, I really don't think it's a skill that's worth having anymore outside of this trade. You want to learn to read charts, not tape, is what I tell people. I really think it's true. So I think that's all I've got on my end. I'm happy to answer any questions that you guys have. Scrolling up here in the VTF. We got HPQ out. HPQ down 5% here after hours. We got Box out. Box smoked after hours, down 8%. Not great. Let me start, actually, before I do the questions in the VTF. Dave, and I'm looking for your email right here. Dave sent me an email that included his journal, just because he thought it'd be easier for him to email it to me than actually type it out into the VTF. But I'm happy to talk about it a little bit, and Dave, I'm sure you don't mind. So basically, Dave here is sending me a question about a new strategy that he's working on, and that new strategy incorporates the what the heck are those things called? Heikin Ashi candles that we spoke about a little bit in yesterday's afternoon meeting, when basically my feedback was I've never heard of them. I did some very peripheral research on Heikin Ashi candles just based on that conversation yesterday, and then I kind of just got caught up with something else and didn't look any further. So I probably should do a little bit more research. And basically the strategy that you're talking about here is more of a scalping type strategy. So it looks like you're looking for more like one-to-one risk reward, which is fine. If you're looking for one-to-one risk reward, what does that mean that you need in order to be consistently profitable? It means that you need to have a win rate that's in excess of 50%. And I do know a couple traders who are really good who trade like that, who basically trade for one-to-one risk rewards and therefore need a win rate in excess of 50%. I would say that's in the minority of the successful traders I know, somewhat significantly. Almost the vast majority of the successful traders that I know in this business are actually wrong more often than they're right. They're wrong more than 50% of the time, but they make up for it with risk reward. So this strategy, being a scalping strategy and looking for one-to-one, is going to be a little bit of the opposite. And honestly, Dave, for the most part here, I've got no qualms or beef with anything that you're trying to do on the email that you sent to me. I can't rip it up because I don't have a way to rip it up. I've never worked with those types of candles. I've never worked with this type of strategy personally, so I don't have any feedback where I could tell you like, hey, I've done this strategy myself in the past, and it didn't work well for me for the following reasons. And by the way, even if that was true, even if it didn't work for me for whatever reason, it doesn't mean that it can't work for you. One of the things that I think is great about trading, and this is kind of the broader answer that I'm going to lead to about your question with the strategy, and I don't think I even need to go over it in any more detail than what I already did, is there are so many different ways in which you can be profitable as a trader. Different products, different strategies, different approaches. There are certain things that they all have in common. It's rules. It's the rules that actually create consistency. It's a game plan that defines those rules, and it's a risk reward and probability of success situation that actually creates the P&L. That's what is in common with every single successful strategy that exists. So when you are, sending me an email here, which I appreciate you doing, that outlines an approach, outlines a strategy that I've never personally implemented, but you can go over in detail what the rules are. That's all I need to see. Um, your ability to be consistent with your rules is more important than what the strategy itself actually is. And it looks like, and this also kind of goes back to a little bit about what I was even reading about these Heikin-Ashi candles. It looks like most people that use them in conjunction with Japanese candlesticks, which looks like it's exactly what you're doing. So in some ways, it's almost like the Heikin-Ashi candles are a indicator, for lack of a better term, that helps you increase your probability of success. It actually almost reads like the opposite. It almost reads like the Japanese candlesticks are actually the indicator that increases the probability of success, and that the Heikin-Ashi is actually the trade itself. It doesn't matter, though, is the point that I'm trying to get across. What matters here is that you have a very specific set of rules that you've implemented, and those rules govern entry, they govern risk, they govern reward, and that's what matters. You then have to have the discipline to be able to implement that consistently over time and with discipline. And I think that in and of itself can be enough for a trader to make money with almost any approach. Seriously, I don't care what the approach is. I spend a lot of time trying to work with you guys on kind of like what my approach is, what works for me. But I'm not the end all be all. I'm not God's gift to trading. So obviously it probably makes sense for a lot of people to learn from what I'm talking about and learn from what I do, because it can help you guys with your own journey. But at the end of the day, you got to figure out what your approach is that matches your personality, and you need to create a game plan, or for a better term than game plan would be a business plan for how to implement that. And Dave, I think that's basically what you sent me. You sent me your business plan. This is my business plan for this specific approach that I want to implement. And within that business plan, you can find the reason for why it exists, the rules for how I execute, the rules for how I manage risk, the rules for how I manage reward, and now I just got to get out there and do it consistently over time. And that's pretty much all anyone needs, I think, to be successful as a trader. You may need to adjust and refine the rule set that encompasses the strategy if the rule set's not giving you the consistent profitability. So that would be the only other thing I would then say to you is now you've drawn up the business plan. Now you got to keep the statistics. So sounds like so far so good on 1 day worth of data, but 1 day worth of data is obviously not enough. You need to now implement this, and you shouldn't make changes based on 1 or 2 days worth of data, right? You need to do this exact business plan that you just sent to me for a couple weeks, a month, 2 months. Then you'll have enough of a data set where you can look and you say, hey, wow, this works great. I'm making money. I'm going to keep doing it. Or, hey, I'm not getting the results I wanted, but based on what I've seen over the course of the last month, I can make this little tweak here to the rules, and I think that'll make the difference. And then you make that little tweak, and now you do nothing again except keep your statistics for another couple weeks or another couple months, and then it's the same thing. Okay, now that I made this little tweak, are my results improved? And if they are, great. Maybe you just want to stick with it as is, or maybe at that point you need a little further refinement and to draw up further data. That's it, guys. I say it all the time, and I think this is what I'm going to be talking about a little bit when I'm in Las Vegas. I still have to work on that PowerPoint. I've been a combination of busy and lazy. I think this is what I'm going to talk about. I don't, especially if I'm speaking to a room of people in Las Vegas that I don't know who they are, I don't know how they trade, I don't know what they trade. I can just talk about. I don't need to know who they are or what they trade in order to be able to tell them how to actually be successful. The key to consistent profitability in trading is to approach markets consistently. Sounds Sounds pretty straightforward, right? We all know as traders that in practice that is significantly more difficult. But the key to consistent profitability in trading is to approach the market consistently. How do you approach the market consistently? But the answer to that is by having rules that govern what you actually do. And then finally, and this is probably the hardest part, is having the discipline to consistently follow those rules over time. But if you can do that, I don't care if you're running an HFT robot, a technical strategy, a quantitative strategy, a fundamental strategy. I really don't care. It can make money. So that's what everyone's goal actually is. It's what you want to work towards. So thank you for the email, Dave. I hope that answer helps. I hope that's what you're looking for. Cool. Next on here, I'm going to Rex in the VTF. Except, hold on. My wife sent me 6 text messages, which is unusual. Let me just make sure it's not an emergency. No, we're good. From Rex, I was looking at Tesla short versus 240 this morning before the open, seeing it failed at 240 yesterday. Okay. Yeah, 240 is a key level in Tesla. We mentioned it again this morning. And they killed through it early. I think that this pivot low, and we actually called out this long, I think, in the VTF. Going long versus the 940 pivot low, I think, was a really good trade. Because you had that like continuation pivot, continuation hammer into equilibrium that was being built out, and it got right back above that 240. I really like that long versus that third 5-minute bar low. And if Ashani is here, I don't know if you are or not, because you had questions yesterday about Tesla with the breakaway gap failure. This is just another trade that you can add to your playbook. Hey, this is another trade that you can add to your playbook after what we were talking about yesterday. But anyway, going back over to Rex, I was looking for Tesla short versus 240 this morning before the open, and seeing it fell to 240 yesterday within its daily downtrend. Yeah, okay. This one is still guilty until it proved itself innocent today. But in the morning meeting, you mentioned Tesla could be a long through 240 again. My question is, what made you have the long bias about Tesla instead of short? Just because it failed yesterday does not necessarily mean that it's a short. I think that the 240 level, it's relatively straightforward. It's just that the 240 level is a key level. And the 240 level failed yesterday because the market did nothing. Stock was a little bit relatively weak. But I don't think that yesterday's price action negated the importance of 240. So it was certainly an if-then statement, as was my Google trade that I was involved in. You know, I said I really only like these: the break of Tesla 240, the break of Google 132, which, going back to Ashani again, Google 132 was the same as Tesla 240 yesterday with the gap above, except the Google one actually worked and Tesla yesterday did not. It was just an if-then statement. If the market's able to be strong, then these key levels on these daily charts for some of these names are still in play. And Tesla 240 is one of those key levels. So, hope that helps Rex. Scrolling through here. Hold on, let me see. Ashani. I have a 3-trade rule. I was only able to keep my losses to a minimum. I took long off the open. I got stopped out on the pullback. Again, that sounds like a statement, not a question. But first of all, I like that rule. You know, giving yourself rules for risk management is key. So, you know, if you've got a 3-trade rule where you're wrong, 3 times in a name or 3 times in a day or whatever, if you're shutting it down for the day at that point, I love that rule, and you should stick to it. You're saying that you took longs off the open and you got stopped out on a pullback. I would have to take a look at what those names were and what your entry was and what the actual trade was to give you any further feedback on that. And then I'm seeing here, I caught the move up on my 3rd try, but I wasn't too confident in the move, so I got out early and I missed the whole move. So that's a mistake. See, and this is what I talk about all the time. Buy the ticket, take the ride. The trade's not worth putting the risk on if you're not going to follow through with the game plan to actually make money if it works. If you take the trade, if you put the risk on, you can't just exit the position because you lose confidence. Your confidence doesn't matter. And that's one of the really hard things also that we struggle as traders to get through, is how you feel in the trade does not matter. I don't care. And someone else sent me an email today about a trade that he took, I think, yesterday, and it was a similar situation. In that case, actually, I think saved him some money. I tightened up my stop losses because I got less confident in the trade. None of us are good enough to do that. I mean, no one I've ever met. I know I'm certainly not. It's so easy for us psychologically once we're in a position to convince ourselves that it's not a good trade. But you already got into the trade. Yeah, Dave, for sure, it's cool. You already got into the trade. So let the trade play out. You already assumed the full risk of the trade. Meaning, if you bought the trade and it immediately went against you and you got stopped out, you're taking the full loss. So if you already put yourself in the position to take the full loss, you need to put yourself in the position to take the full gain. And don't think that you're so smart that you can be in a position for a period of time. I don't care if that period of time is 2 minutes, 30 minutes, or 2 hours. And think, hey, something changed and I should just get out to save myself some money. Let the trade actually play out. And also, looking over at Tesla, if you bought Tesla anywhere here in the first 15 minutes off the open and you got stopped out, you probably were not trading well. You didn't take the trade properly. Unless maybe if it was within the first, I need to actually look. Oh, this is a 2 minute. Unless both of those trades were within the first minute or whatever, you bought the second the thing opened, and then you got stopped out on this quick downside tail that happened in the first minute. Otherwise, you just didn't trade it right. The breakout level is 240. So if you're buying the breakout at 240, the only stop that you can use if you bought 240 in the first 5-minute bar is the low of the day. It's the only appropriate stop loss. You need to risk $2.24. If $2.24 is too much risk, and you are therefore not going to trade the trade correctly, don't take the trade at all. Don't take the trade at all. You're better off not taking the trade at all than trading it wrong. So the trade here in Tesla is very straightforward. You're buying 240, you're risking $2.23. If you can't risk $2.23, you don't take the trade. That's trade number one. It's a breakout trade. Trade number two is the continuation hammer trade. It pulls back into the equilibrium area, trades back through 240, which we know is a really key level, and you buy either back through 240 or through the high of the day, which at that point was 240.60, versus the low of the tail, which is 238.82. So in that case, if you bought 240, you're risking $1.18. If you bought 240.60, you're risking about $1.82 on that. So it would have been less risk than the first trade, but still a significant amount of risk. So same deal. If you can't afford to risk $1.82 or whatever I just said, you can't afford to take the trade. And if you can't afford to risk $1.50 or so in Tesla, then you should never ever look at Tesla, because finding a trade in Tesla with less than $1 worth of risk is very, very, very difficult to find and pretty rare. So I hope that helps with trade setups. Anyway, going back up here into the VTF. All right, so we did Rex. I'm trying to figure out where I was. How's your skill in determining whether we are forming a right shoulder? So the right shoulder in the market, I know that got mentioned on the daily chart a couple days ago, is something that could potentially be, forming with a neckline. I think we spoke about kind of in this 130 to 132 area. Yeah, it could certainly happen. I don't know. I would not be predicting that now. I need that to actually form and begin to play out. I've seen so many potential head and shoulders over the years that never became head and shoulders, especially on the upside. If it actually fully builds out and breaks the neckline low, it's an extremely powerful pattern. I just feel like most of the time when you see a potential head and shoulders building, it never actually gets to the point where it fully builds and actually triggers. because otherwise this is just a contested uptrend that continues, which if anything is the higher probability situation. And that's not the reason I sold 3 FANG stocks. It's just because my game plan dictated that I'm supposed to sell Apple into 185, and it got close enough to it. Amazon into Amazon anywhere above 135, and that did that. I liquidated above 135, and Microsoft at 326, and that also happened. So I just was following my game plan. Just following the game plan from Leith. What is your rule for when a stock goes past your stop loss during extended trading hours? Okay. So it's a little bit different than if the stock gaps past my stop loss. If the stock goes past my stop during extended hours, well, it shouldn't go past my stop. I should just be able to hit out through that price during extended hours because the market's still open unless I had already shut down my computer for the day, which could happen, in which case I'm basically just dealing with the gap situation. So again, if it's 4:30 p.m., if it's right now, or 5 p.m. right now, and one of my trades is getting to the area my stop loss is supposed to be, assuming there's enough liquidity, which you have to pay attention to, which there probably is, otherwise it wouldn't be rapidly moving towards where my stop loss is, that I would just hit out after hours and I would take the loss I'm supposed to lose. I think what you're actually trying to ask, though, is the rule that I have for when a stock gaps past my stop loss. Meaning, Friday comes around and I, keep a position overnight because I've got a good profit cushion in it. I think I'm in a win-win. And unfortunately, over the weekend, bad news comes out for that stock, and the stock gaps down, past where I was planning to have my stop loss, just because of an unforeseen news event. It's not like an earnings report that I knew was going to happen, in which case I set myself up for failure. It is because a random piece of news that I wasn't expecting came out, and it's gapping past my stop loss. So that's the worst situation you can ever find yourself in as a swing trader. And that's, first of all, why I've got that 1% rule where I always want to be at least, and sometimes 1% is not enough. I want to be at least 1% in the money on my positions in order to actually keep them overnight. Because if I'm 2% in the money on this position, and the next day the entire market gaps down 2% because there's bad market-wide news, and my stock gaps down 2% also, all I did was give back the profit that I've already made. I'm not losing anything beyond my stop loss or what I was planning on risking or anything like that. So first of all, we want to have a good profit cushion in order to keep positions overnight because it mitigates these adverse situations when they actually do occur. With that said, in the market, anything can happen, and sometimes adverse news could cause a stock to gap up or down, 10, 15%. And you maybe, had a 2% profit cushion, and then bad news happened and the stock gap down 10%. And it was unexpected, and that's really unfortunate. And again, that's the danger of swing trading. Those situations, from my standpoint, are very rare. I've been consistently swing trading for, I don't know, at least 8, 9, 10 years at this point. And that has happened to me. It has happened to me, but it's happened to me I couldn't tell you what a number is, but it's happened to me very few times over the course of, 8+ years of swing trading. But if it does happen, I have a rule for it, because like I was saying earlier, rules are the thing that breed consistency, or having rules and then discipline to follow them breed consistency, and consistency of approach, and consistency of approach is what creates consistency of P&L. So that rule is what I call the 15-minute rule. So whenever I have a stock that gaps against me, it gaps past my stop loss, I am already losing more money than I was planning on losing in that trade. I wait 15 minutes past the open. So the market opens at 9:30. It's past my stop loss. I do not put a stop loss in. I do not hit out of the position. If anything, I sometimes add to the position in order to average my price in my favor, try to work the trade a little bit, if I can avoid getting stopped out. I wait 15 minutes. I wait till 9:45. The reason why I wait 15 minutes is because whenever there's panic selling or panic buying, if it's a gap up, whenever panic selling comes into the market because stock gap's down so big, you're not the only person that's trapped. Other people are trapped as well, and a lot of them will panic sell the second the market opens. I don't like to participate with panic. If everyone's panicking, I don't want to panic as a general rule. If anything, I oftentimes want to do the opposite. I might want to come in and be a buyer when everybody else is panicking. But typically, panic selling lasts for not much more than 15 minutes. So my 15-minute rule is stock gaps past my stop loss. I don't put in a stop, which in theory means I have unlimited risk for 15 minutes. Once 9:45 hits, whatever the low is at 9:45, even if it's only a penny above that, I put my stop loss in at the low of the first 15 minutes, and that becomes my new stop loss for the trade. I try to average against it so I can work the trade, and I take it from there. And if I get stopped out, I get stopped out. But it's actually been amazing how many times that's happened, and I haven't gotten stopped out, where that first 15-minute low becomes a real low, and then I average down, and I'm actually able to manage the position, and it works in my favor. Which I see, actually, because I know which name you were asking me about, that would have worked perfectly. I'm sure you don't mind, so I'm just going to mention it. If someone was unfortunately stuck short 3M over the weekend and it gapped up really big, I would wait 15 minutes. So after the 9:40 bar ends, I would look to see what the high of the day is. The high of the day at that point is 105.65. I would put my buy stop in to liquidate my position at 105.66. I would add, if I hadn't already added to my short, and then in this pullback, I probably would have been able to, have that added that short, work the position a little bit, and I probably would have kept the position and then gotten stopped out of the remainder of it this morning, when I traded through the new stop loss at the open. That's how I would have traded it. In another circumstance, maybe this thing actually would have even continued to work down in your favor, and you could have managed the position even more successfully. So, I hope that helps, and I hope you don't mind that I blew you up with what name you were talking about. Cool. Next on here is from Elliot, Trade Review. I took Tesla at on the 940 bar. Okay, cool. And it was my single best trade yet. I love it. I love this. Took it on 940 bar. It was my single best trade yet. I took a grade B risk on it. I think that's fine. My question is this a trade to take more than average risk given the possible break of 240 level, and I had only 70 cents worth of risk on it? So I think that, I don't think that the 70 cents worth of risk matters, because when you're talking about taking more risk, that doesn't mean more tier size, it means more dollar risk, right? So if you're talking about more risk, 70 cents worth of risk versus, $7 worth of more risk, of space risk, doesn't actually matter. If you're judging the trade better or worse, you're taking more dollar risk. Meaning, if you wanted to risk, just using numbers, $700, then you would take 1,000 shares. If you wanted to risk $7,000, wait, did I just say that right? Yeah, then you would take 10,000 shares worth of risk. So that's just the question is, do I want to take more size versus my 70 cents risk to have more dollar risk overall on the trade? But I think that the B-level grade is appropriate because, I don't know about you, I wasn't expecting the market was going to do what it did today. This is still pre-10 a.m. It's before the JOLTS number hit. The market, I don't think, had really broken out at that point. We weren't above key breakout levels yet for the market that made this market much more bullish. So I get it. Tesla 240 is important. Maybe you could argue there's some relative strength in this name early. The market was trading okay early. But it wasn't like the market was already broken out above key levels. It wasn't like the JOLTS number had already hit. It wasn't like Tesla was particularly in play for any reason. So I think that the B-level risk is appropriate for it. And it still turned out to be your best trade so far, which is awesome. Also, in general, the skew of risk skew is something I need to work on. what's the best way to do that? I've just been going through my trade history and grading things retroactively. That's a great starting point. Hopefully that will help me see and judge things quicker in real time. Yeah, that's exactly what I recommend, is grade things in hindsight. They'll help you to grade things better in real time as you just kind of gain more experience with it. And then the idea of risk skew is that you want to find a base amount of risk that you would want to more or less risk on every trade that you would take, and that number should be based on what your daily maximum loss is, and what your daily maximum loss is should be based on what your account size is. But again, just use simple numbers. Maybe your maximum risk is $400 on a given day, and you want to risk $100 per trade on average. That gives you 4 shots in a given day, but then you want to skew that, where maybe that A plus trade is actually risking all $400, and maybe your B is risking, I don't know, $200, and then your $200 is probably a little heavy, but you get the point. And then your C is risking $70 or something, and then it averages out to be $100 or whatever that averages to what you want it to be overall. So that's kind of how you want to build up the system for yourself. I just butchered the math behind those numbers, but I think you get the point. But yeah, no, great job on Tesla. Love the trade. I think you did it appropriately. From Michael, on Oracle or in general, when a company sells off hard on the opening 1 or 2 candles, but holds the gap up and slowly creeps back to highs, do you look for a bearish failure because of the energy it spent to get back to the day highs, or as bullish since it held the gap and is about to negate the red Maribozu? Sure. So I really like the trade where you get the news event and then you get the pull in the opposite direction of the news event at the beginning of the day to allow for the ADMA catch-up trade. And this Oracle is decent with it. Meaning, I love when you get big gap up because there's news or earnings or something, and then you get the heavy price correction early on, and then at the ADMA you get some sort of trade set up, whether that's a hammer or it's a base that breaks higher or it's an inside and up or something like that. That's a good trade that I really like. The reward can be a little bit tricky because, at least initially, the reward can be a little bit capped based on that high, but not so much because it's not like this thing broke. All this did was give a technical price correction to the ADMA. So I probably would want to be booking some into highs, but also keeping some in case that opening high is able to break, because all you had off the open was a price correction. So I don't think that that's inherently bad to see those first couple candles sell in this situation. And if anything, it actually creates one of my favorite trade setups. So appreciate the question, Michael. Continuing to scroll through here. Cool. Let's see. Min and Dave talking a little bit. That's great. Alright, looks like I got through everything in the VTF. Let's pop over to YouTube. What's up, Robert? From Kevin G. How do you counter the thought that the tape shows you the move before it enters itself on the chart? At times you'll see buyers and sellers holding a level that may not be as clear on the chart. Sure. So what I used to say all the time, and the argument that I used to utilize for the importance of tape reading back when I was a big believer in tape reading, is that the tape shows you the now, and that when you're looking at charts, you are inherently looking at the past. And again, the tape shows you those buyers, those sellers in real time. The problem is that reading the actual buyers and the sellers in the tape has just become extremely difficult compared to how it used to be. It used to be just a much more simpler process. They weren't as sophisticated in hiding what they were doing. And now there's just a very high level of sophistication, as most execution firms and execution traders are actually utilizing robots to be able to execute, and those robots have been analyzed backwards and forwards in order to be able to maximize the success of their pricing and to not get picked off by day traders like me from back in the day. So I totally agree with your statement. The tape shows you the now, charts show you the past, but I don't think that actually matters. I think that when you're looking at trade setups as they form on a 5-minute chart, you can see. And sometimes I'm even looking at the candles developing in real time before they even close. Actually, I always am. I'm looking at these candles develop in real time. So yeah, it's kind of like the past in combination with now. I see that this hammer is actually forming. I might enter the hammer before the hammer itself is closed, because I'm deeming that there's a high probability that this candle is going to close in the way that I'm looking for. It's already started to actually do that. And I've also learned to realize that I don't need to have the exact low and the exact high. When I traded more based on tape, it would be more like the Neo trade today, where I was able to capture the exact low. So it would be like, oh, here's a refreshing buyer, right? I found this refreshing buyer on the tape, on the level 2. I'm going to go long off that refreshing buyer with a 2-cent stop loss and see what it can do. But they don't just sit at that price anymore. They measure the weight on that price. So that buyer might not disappear, but if they're selling into that buyer, the buyer pulls and comes back into a lower price. And I just went long off that buyer, and I'm getting stopped out, even though that buyer might actually still be there, because the buyer's recognizing that it can, come in and buy at the lower price. So one, I think that learning to properly read those buyers and sellers is more difficult than it ever has been. Two is that they've designed themselves to not let themselves get picked off by discretionary day traders anymore. And three is that I really don't need it. I don't need it. I find that I'm better off with the looser risk and the looser space that comes a little bit more from a charting type of trade than the tighter risk and the tighter space that comes from the smaller tape stuff that just shakes out all the time. And when this stuff started to get a lot more difficult, I really found myself churning a lot. Like, it used to be, you'd have trades that work and trades that fail, and I would trade a boatload of volume, but more times than not they would work, and you'd be able to read the buyers and sellers a lot more easier. And as it got more difficult, I started churning significantly more. Meaning, I would think I would see this buyer, I'd go long off of him, I'd get stopped out, the stock would uptick, oh, I knew the buyer was still there, I would rebuy, I would get stopped out, I would rebuy, I would get stopped out. And, it would play out sometimes that by the time I actually caught the trade after getting stopped out 5 times, I was just trying to make the loss back. And I realized that if I just gave it the space to the low of the candle to begin with, or whatever, that I could have just bought the thing one time and actually just made money in the trade. And that was kind of the beginning of me really adjusting my approach. And, Josh Leffler, who's on vacation this week, he pays me a great compliment from time to time, which I don't mind repeating. He says that I'm the best tape reader that he's ever seen. And he's been in the business for a long time. And, I just don't talk about it anymore because I don't think it's important. But every once in a while, like after hours on earnings, I'll sit here, in an afternoon meeting and just read the Apple tape for a half hour. And that's also, by the way, one of the times in which I think the tape reading is actually still important, is news events a little bit, definitely earnings after hours. The after hours tape trades much cleaner than the during hours tape, but only on earnings reports. So how often does that actually happen, where we get these really significant earnings reports where I'm going to be trading the tape after hours? Not that often. But the charts are there every day. So, what I tell traders that are newer at this point, and this is based on my own experience, and believe me, I would love for some of those trades that used to pay me money back in 2010, 2011 to come back, but they're not. So if you're a new trader and you're getting involved in the business, learn supply and demand as the charts represent them. And then once you got that mastered, if you want to learn to read tape for special situations, like the step and shorty from today, like trading an earnings report, it can certainly help with execution a little bit. If I'm trading the chart and I've got a bid at 47 cents, let's say there's a buyer at 48 cents, well, I bring my bid up a penny or two, and I get a fill that maybe I wouldn't get otherwise because I'm able to read that. So I'm not going to say it's useless. I just think that, you know, if you're newer to trading, that you're better off starting elsewhere for your education. Yeah, just like a layer of probability. Cool. And from Gabriel San Andres. How would you rate the double inside candle on the 5-minute chart in Neo? We're talking about this, I'm pretty sure. Along with the extension from the ADMA letter grade. Would it be another good entry? Yeah, so I remember looking at this resistance that came from these inside bars and wanting it to break up because I was long. And I knew I probably would make more money, but not actually wanting to take it as a trade. I think at this point it's like a B. You know, you have extension, so there's room for this to break up to go. But the more time this spends going sideways, the worse your risk reward becomes because this ADMA is rapidly catching up. So I you know, it's like a solid B minus type trade. It certainly is still an okay entry if you bought like, you know, 990 versus, you know, 975. You're taking on like 17 cents worth of risk, and your reward profile is, you know, roughly I don't know, 27 cents, 28 cents worth of rewards. You got a 2-to-1 there, but that's assuming you get the full price correction up to the ADMA on a name that's trading weak on an earnings report. So I don't like love it, but it's certainly a trade. Thanks, Gabriel. Thanks, Kevin. Looks like Eddie Vick snuck one in. May I inquire a bit about trading psychology, how to stay disciplined every day? Man, that's the hard part. Let me tell you, that is the hard part. I was talking to another one of our traders about that a little bit today. And try not to rush into certain trades. It's a mistake I make also still. Sometimes candle and order flow, I just can't resist the temptation of new positions. Tell me about it. Tell me about it. I also sometimes just can't resist the temptation of new positions. And I'm currently holding more than 50 positions. You got more than me, perhaps more than I needed. I have such a greedy mentality when dealing with a lot of my trades prior to jumping into T3, and currently still have this bad habit, which is limiting my performance. I really wish I can improve on this to keep it up. Yeah, you know, what you're describing here is something that's really difficult, and it's something that I personally still genuinely struggle with. I really do. You know, it's hard for me in particular. Not that this is about me, this is about you. But, you know, for me particular, like, I sometimes have days where I come in the morning, and I look at the market, and I look at how I'm currently positioned. And I say to myself, I don't want to do any individual stock research today because I really should not be putting on any new trades right now. I say that to myself sometimes. And but then I say to myself, like, dang it, I've got, you know, 125 people that are about to listen to this morning meeting, and they don't want to hear me say, hey guys, I didn't do any research on any individual stocks today because I'm not looking to add any new positions because I have more long exposure on and more positions on than I already should. So then I proceed to do an hour plus worth of research for the team more than for myself. And when I do an hour plus worth of research and then I explain it in the morning meeting, oh man, it becomes so hard for me to not take that trade. And I do, a lot of times. Sometimes I am disciplined enough to not. And honestly, there's plenty of other times where my discipline lacks, and I don't. To the point where I don't have it in front of me right now, but there hit a point one time when I was in Idaho this last winter that I actually wrote on a big piece of paper right in front of me, and I just said, no new names on a big piece of paper, and I just had it there right in front of me. And that was to remind myself that until I took some risk off the table from where my overall portfolio was, that I could not allow myself to really be putting on any new risk right now because I'd be violating my risk rules. But it's so hard to do that when you spend an hour and a half doing the research and explaining the trade idea and everything else to not actually put the trade on. It's actually, your question here is actually, might be one of my top 2 struggles personally with my own trading at this point, is actually not taking the trades. And that's why, like, you know, I can be really happy with myself. Like, you know, I called out that PDD trade at highs and it worked really well. And I was like, I don't need the stress. I don't need the headache. It's hard to borrow. I'm not even gonna look and see what the borrow costs. I just don't care. I don't want the trade. I don't want to be putting on any new trades right now. And that's more big picture for me than anything. And it's hard. I wish I had a really good answer for yourself, for you. Mental preparation is a really big point of it. You know, for me, the big thing would be, if I wasn't running a team, I wouldn't research any other stocks. If I already felt I was at my maximum position limit, I wouldn't research any new names, because no new names actually matter to me because I can't trade them anyway. So I would sleep in a little bit later, and I would just research the names that I'm already in, and I would do my broader market research, and that's it. And I wouldn't look at NVIDIA at all if I wasn't in NVIDIA and I'm not supposed to get into any new positions. I wouldn't even do any research on it. But again, you know, I got responsibilities here to the team, so that kind of gets me in a little bit of trouble. So that's 1. 2 is, when I find myself on any given day, and this happens to me, it happens probably to everybody, where I was undisciplined in that day, for whatever reason. I didn't trade well, I violated my rules, or I was on a streak where I haven't been trading well. I'm in the trading slump. All these things happen. I've really created a mantra for myself, and I keep that mantra in the forefront of my head, and I really say it to myself the next morning, almost on repeat, where if I haven't been following my rules, I haven't been disciplined, I say to myself, literally on repeat as a mantra the next morning, all I need to do today in order to be successful is to do the right things consistently. All I need to do today to be successful is to do the right things consistently. And that means following my rules. And that's all encompassing. It means not putting on new positions if I'm not supposed to put on new positions. It means not fighting stock if I'm not supposed to be fighting stock. It means adhering to my risk limits if yesterday I violated my risk limits. All I'm going to do today is do the right things consistently. And I know that if I just do the right things consistently over time, I will make money. But I get in trouble, and we all get in trouble when we stray from that. And it's all mental. It's all psychology. So, you know, write it down, journal it after hours, reread your journal the next day, write it on a big piece of paper, plaster it on your monitor. You know, do whatever you got to do to make sure that you don't repeat the thing that you're not supposed to do, which for you, it looks like right now, and for me, this is a thing also, is, hey, I'm at my, you know, maximum portfolio risk, I'm at my maximum position limit here, I am not going to violate it. So, great question there, Eddie. Appreciate it. All right, gang. Great meeting. 5:20. I'm going to wrap it up. If you're in YouTube, you know what to do. Give me the thumbs up. If you're not on the YouTube, go to the YouTube and give me a thumbs up. Have a great night, everybody. I'll see y'all tomorrow.